This podcast is for informational and educational purposes only and should not be construed as investment, tax, or legal advice. Any examples or frameworks discussed are general in nature and may not be suitable for all investors. All investing involves risk, including the possible loss of principal. Past experiences and planning approaches do not guarantee future results. For a lot of people, tax deferral feels like an obvious win. You earn more, you defer your taxes, and then you just repeat. And for a long time, it really can be a win. But among high net worth families, there is a risk that I see where using the strategy and executing it seemingly perfectly creates a problem that's just as significant as the one that it's meant to solve. So this risk that I see is not an investment itself, it's their IRA. If you start early and you are able to save a lot and perhaps move company retirement plan money into your IRA, then you can really build a lot over decades without having that tax drag. And on the way up, the strategy seems to make perfect sense. You're deferring income while you're in your higher earning years, and you let those assets just compound tax deferred, and you're basically just delaying the tax bill for as long as possible. But that's where the risk starts to build, because eventually you are going to pay the IRS. And at a certain point, this stops being efficient and it starts becoming dangerous. So I've seen situations where the required minimum distribution, the RMD, it'll push over $300,000 in a single year. So with that income, it could force families into the highest tax bracket. It can eliminate flexibility in income planning, and it could possibly create a worse tax outcome than what they had originally saved when they deferred. So in other words, the strategy that once reduced taxes could end up increasing them overall. And the really interesting part about this is that it doesn't stop there. So for a lot of families, the bigger issue shows up in the next generation. So there's a new rule. It's not that new, since 2020, but it says that if your assets in your IRA pass to a non-spouse beneficiary, in most cases, they're often subject to the 10-year distribution rule, which means that your heirs will only have a decade to unwind decades of tax deferral, and that ordinary income is potentially stacking on top of already high earnings depending on when they start inheriting. And obviously that creates a very limited amount of flexibility in the timing. So what might be viewed as a major gift could end up feeling like a major constraint for your kids. So there's some signals that I see that if these are happening to you, then you're probably going to want to take a look at how you're planning out your IRA distributions and inheritance. So if you don't need the IRA distributions for your lifestyle, that's one red flag. If you're already in a high tax bracket, that's another. If your children are in or are likely to be in high tax brackets, that's another red flag. Ultimately, if the estate tax is in play, which applies for $15 million per person, $30 million for a couple as it stands right now. Anything above that, you're getting taxed 40% on the assets. So if all four of those are in play, or even if three of the four are in play, you're probably going to want to take a closer look at this. And the question stops becoming how do we defer taxes to how should we intentionally pay them? Because you're going to have to pay them. You should at least have some say in the matter if you're able to. I just worked on this scenario with a family, so this is why it's so top of mind today. They had huge retirement account savings. Their income was already at the highest level of taxation, and there's very little expectation that it was ever going to change. And they're also in that estate tax threshold. Also, their children are high earners. So on the existing path, required distributions are going to remain high. The inherited distributions would be compressed into this short window, and then estate taxes would layer on top of that. So the tax deferral was really a small piece of the puzzle now. They weren't just compounding account balances anymore. They're compounding future tax exposure. At this point, every dollar earned in that IRA was facing estate tax and income tax. So in California, that would be a 90.3% cumulative tax exposure. Now, there's different ways of looking at that because the estate tax would be due immediately, but the income tax would be drawn strategically, hopefully, and not all that money would be taxed all at once, but it would be taxed eventually. even though it might not land exactly on 90.3% because of changes in their circumstances, it seemed very likely. And that is a really scary thought. So what they did was, instead of continuing down this path, they pivoted. They chose to accelerate the tax because it was expected to be a better long-term outcome. It's not the case in all situations. Like, you have to look at all your specific circumstances and make your best judgment, but it could work out just like it did in this case. Some of the things that put this strategy at risk are losing your optionality if tax rates decline in the future. Everyone can take their own opinion on that. And there's also liquidity constraints. So if you want to do a major tax payment right now, you do need the liquidity to make it work. So in this particular case, they decided to move forward. They did a mass Roth conversion of their total traditional IRAs, which means they eliminated the future required distributions except for that 10-year total distribution. But that meant that they shifted their future growth into this tax-free environment for the remainder of their lives, plus an additional 10 years. So that was a big win. And then they also created a lot more flexibility for their kids, and they reduced the size of their taxable estate because they paid a large tax bill. Now, they're still going to end up paying a lot of taxes in this scenario, but they have more control over it. And what I really see is that when you get to the higher levels of wealth, the objective is rarely minimizing taxes in any single year. It's managing the lifetime and generational impact of those taxes. And it's really interesting because the biggest risks in a portfolio may not feel risky at all. What we're talking about here is tax risk, not market risk. So it can fly under the radar really easily if you're not being careful. And it's easy for something to fly under the radar when it's been working so well for you for so many years. But you got to recognize when that shift comes and address it as soon as you see it. Ultimately, if you don't make this decision intentionally, the structure that you built around it is going to make it for you. And that might not get you the best result.